Welcome back to Fathom in person. We're here in the beautiful Fathom Gardens with Brian Davidson, our lead US economist, to talk about the CEI. So Brian, the CEI sounds like a US TV show, but what is it?
Well, sadly, it's not a US TV show. It's even better than a US TV show.
I thought so.
Yeah, it's CEI Shoreditch. It's one of our proprietary indicators that we've created at Fathom, and it stands for the China Exposure Index.
So what does it do? How is it constructed?
Well, the China Exposure Index, we created it when Donald Trump, shortly after he won the election, he had a lot to say about China on his campaign trail, and there was a lot of talk about imposing tariffs on imports from China. So we thought, well, what would be a good way to gauge the market or to gauge how people are seeing the prospects of a trade war? So what we've done, we created an index which has US firms that are listed in the US that derive a lot of their revenue from China. So some of these firms derive between 15% and 85% of their revenue from China. So if there was to be some kind of trade war or sanctions would be imposed on US firms in China, these firms would be the ones that would presumably suffer, and their share prices would fall if there was a big trade war, you would have thought.
Is that what you found then?
Well, surprisingly, I suppose, the answer was no. It's a relative measure of their performance, so we take their performance on the stock market and we compare it to their peers that are listed in the same sector as them. And actually, it has outperformed since Donald Trump won the election. It rose steadily for the first year after him winning, and there's a few interpretations for that. You could say investors, despite his rhetoric, they thought that there would not be a trade war or any sanctions on these firms. Or China's economy was growing quite strongly when Donald Trump took office. The renminbi was quite strong, which when you convert their earnings back to dollars, that would have boosted the earnings in dollars of these firms. So it was going up quite a lot. These firms were outperforming their peers. But over the last few months, it has fallen as the tensions between the US and China have escalated.
And could you also say that perhaps the CEI going up was also a reflection of the fact that maybe the market was voting in terms of expecting Donald Trump to open up bigger markets for these firms that had such an already a foot in the door in China?
Well, yes, that's definitely one interpretation. The US imports a lot from China. It doesn't export a lot to China, as I'm sure most of our listeners are well aware. So essentially, what we thought, and what maybe many investors thought, was that it could be that the trade negotiations between the US and China could be likened to a game of chicken. And Donald Trump could be saying a lot of things in order to try and extract some concessions from the Chinese authorities, such as opening up their markets for US imports. And as you've pointed out, that would be good for the firms that are already there. They could get even better access to the Chinese market for their products. So that's one interpretation. People might have been expecting an outcome that would favor US firms. At least that's what seemed to be happening for his first year in office. But over the last few months, sentiment has fallen away a little bit, and these firms have underperformed since March, when it was announced that the US would be imposing tariffs on imports from China, and they haven't really ceded much ground. They've done some tit-for-tat measures. They've threatened to impose tariffs on imports from the US.
And also, if I'm not mistaken, Fathom's view is that essentially the trade tariffs work, in inverted commas, best when they're in the threat phase. So is this the beginning of the end? Is the market expecting things to have moved on beyond the threat phase?
Well, that's right. I suppose tariffs do work best in the threat phase. That is Fathom's view on this. Nobody likes a trade war. I mean, a trade war is not good. Free trade is beneficial. What you could say is that, trade between the US and China hasn't been free for many years. That's certainly the position of the US administration. They've complained that China have subsidized many of their industries, they control their exchange rate, and they force transfer of intellectual property products. So by threatening and maybe getting the other side to behave the way you want, or give you some concessions, yes, that might be a sensible strategy. But what we've seen at the moment is things have started to escalate, and there's been a tit-for-tat imposition of tariffs.
So would you expect the CEI to reflect this? Do you think as the prospect for the CEI to be to keep on signaling further downside for these firms, or you think that perhaps as long as the tariff they imposed remain fairly limited, and then maybe we've possibly seen a bottom?
Well, it's obviously hard to say. A lot of it depends on political forecasts and what exactly the US administration does and how the Chinese administration responds. And so far we haven't seen any signs of either side backing down. So things may well get a little bit more tense before they get better. And in that scenario, at least in the short run, you would have to say, well, if tensions escalate, it's not going to be good for these firms, and they will possibly continue to underperform. But I should point out as well that since Donald Trump won the election, the CEI is up. So that means these firms have outperformed their peers since his election victory. And there's another aspect too. There's the Chinese economy is slowing. We expect it to continue to slow, and that won't be good for the earnings of these firms. So that could be getting priced in, as well as a weakening currency from China. Whether that's market forces weakening the currency, or whether that's the authorities weakening the currency themselves, it's unclear at this stage. But if that continues, it probably wouldn't be good news for these firms.
Well, it certainly sounds as a tool worth having in your box, then, in your box of tricks, and keep on monitoring. Well, thank you, Brian. It's all been very interesting, and see you next time.